The on-neckline pattern is a bearish continuation pattern that signals a potential continuation of a downtrend in the market. There are variations of this pattern, namely the in-neckline and the thrusting line patterns. These variations share core similarities with the on-neckline, but showcase subtle differences in their formations, particularly concerning the closing prices of the second candle relative to the first. For instance, in the in-neckline pattern, the second candle closes slightly above the closing price of the first candle, but not by much, indicating a bearish sentiment is still in control, but with a slightly lesser momentum compared to the on-neckline pattern. On the other hand, the thrusting line pattern has the second candle closing well into the body of the first candle, but not exceeding the midpoint, suggesting a stronger continuation of the bearish trend than the in-neckline pattern, but with some resistance from the bullish side. Understanding these nuances between the patterns is crucial for accurate market analysis and decision-making. It helps investors and traders to assess the strength of the continuing bearish trend and to adjust their strategies accordingly. These patterns, by giving insights into market sentiment and potential future movements, can be an essential tool in the toolkit of those looking to navigate the complexities of financial markets. The in-neckline is recognized as a bearish continuation pattern, mainly identified during periods of declining market trends. It serves as an indicator that, despite temporary bullish efforts, the prevailing downward momentum in the market is likely to persist. This pattern unfolds over a two-candle formation within a downtrend. Initially, a long black candle appears, which is followed by a smaller white candle. The key feature of this pattern is the opening of the second candle within the body of the first one, and its close slightly above the closing of the first candle. Despite the minor bullish signal represented by the closing of the second candle, the overall sentiment remains bearish as it does not significantly penetrate the losses of the first day. This subtle configuration suggests that the bearish market players maintain control, indicating a continuation of the downtrend. Understanding this pattern can be valuable for investors and traders as it provides insight into potential market movements, allowing for informed decision-making regarding holding or disposing of assets in anticipation of further decline. The in-neckline pattern in technical analysis is observed in candlestick charts and is recognized by the presence of two specific candles. The pattern starts with a long black or red candle which illustrates a strong downward movement, indicating that sellers are in control for that period. This is then followed by a smaller white or green candle. The crucial aspect of the smaller candle is that it opens at a lower price than the previous candle's close, yet it manages to close near the closing price of the first candle. This demonstrates a modest recovery effort by buyers that fails to reverse the trend, thereby hinting at a continuation of bearish sentiment. The sequence of these two candles is particularly significant. The large drop captured by the first candle sets a negative tone. Then, the slight recovery attempt during the next session, as shown by the second candle, suggests that buyers tried but were unable to shift the momentum significantly. This failed recovery is a key indication for analysts that the downward trend is likely to continue, making the in-neckline a bearish continuation pattern. By identifying these patterns, traders and analysts can gauge the market sentiment and make informed decisions about potential future movements. It encapsulates the subtle interplay between optimism and pessimism in the market, providing insights that can guide trading strategies. The in-neckline pattern in financial markets is a bearish continuation pattern, signaling that despite a slight pushback from buyers, the dominant sentiment remains bearish. This means that sellers are not yet willing to give up control over the market direction. Even though there may appear to be a brief rally or increase in prices, this pattern suggests that the overall downtrend is expected to continue. It acts as a subtle indication that the strength of the selling pressure has not weakened substantially and that any attempts by buyers to reverse the trend are likely to be short-lived. Understanding this pattern can help investors recognize that the downward movement in prices might persist, informing their investment decisions in anticipation of future market movements. The in-neckline pattern is recognized in the realm of technical analysis as a bearish continuation indicator. This particular pattern emerges during a downtrend, serving as a signal that the current downward momentum is expected to persist rather than reverse. Essentially, it reinforces the anticipation that prices will continue to fall. Upon identifying an in-neckline pattern, investors and traders can interpret this as a confirmation that the existing bearish trend is likely to extend, providing them an opportunity to align their trading strategies accordingly. This pattern functions by validating the current market sentiment and projected direction, making it a valuable tool for those looking to capitalize on or hedge against continued downward movement in the market. In analyzing the in-neckline as a bearish continuation pattern, it's important to understand the role of volume and other indicators in confirming this pattern. Initially, the appearance of the first candle in this pattern should be accompanied by a higher volume. This suggests strong interest in the direction indicated by the candle, which in this context is downwards. Following this, the confirmation of the bearish continuation comes with additional bearish candles. These candles further indicate the market's movement in the anticipated direction. Additionally, using other indicators such as moving averages or momentum indicators can provide further confirmation of the bearish outlook. Moving averages smooth out price data to identify the trend direction, while momentum indicators help measure the speed of price changes. When these indicators align with the pattern observed, it strengthens the case for a bearish continuation. In summary, volume plays a crucial role in confirming the in-neckline pattern, with other indicators such as moving averages and momentum indicators providing additional support. This combination of tools helps traders understand market dynamics and potentially forecast future movements with greater accuracy. The in-neckline is a pattern observed in the financial markets, particularly useful in identifying potential bearish continuation scenarios. This pattern emerges on a chart where the price of an asset, following a downward trend, experiences a slight recovery but fails to rise significantly above the previous low point, suggesting that the downward momentum is likely to continue. While the in-neckline itself provides valuable insights into market sentiment, indicating that sellers are still in control despite a brief respite, its predictive reliability can be greatly enhanced when used alongside other technical analysis tools. For traders and investors, relying solely on one indicator or pattern can be risky. The financial markets are complex and influenced by a myriad of factors. Therefore, to make more informed trading decisions, it is advisable to incorporate additional technical tools such as moving averages, volume indicators, or momentum oscillators into the analysis. These complementary tools can provide a broader view of market trends, support and resistance levels, and investor sentiment, offering a more comprehensive framework for evaluating potential trading opportunities. For example, if the appearance of an in-neckline pattern coincides with a declining moving average and high sell volumes, it may reinforce the bearish outlook, providing a stronger basis for expecting a continuation of the downward trend. Conversely, if other indicators suggest a strengthening market, traders might be cautious about acting on the bearish signal from the in-neckline alone. In summary, while the in-neckline is a useful tool in identifying potential bearish continuations in the market, its effectiveness is significantly improved when combined with other technical analysis tools. This approach allows traders to cross-verify signals and make more well-rounded, informed trading decisions, ultimately aiming to enhance the accuracy of their market predictions and the effectiveness of their trading strategies. To strengthen the predictive accuracy of the in-neckline pattern, which indicates a continuation of a bearish trend, traders often turn to additional technical analysis tools. The Relative Strength Index, RSI, is utilized to spot conditions that may be considered oversold. When the RSI shows a stock or asset is oversold, it suggests that a potential reversal or a pause in the downward trend might be near, providing traders an opportunity to make informed decisions. Another important tool is the Moving Average Convergence, Divergence, MACD. Traders look for bearish crossovers as confirmatory signals that support the bearish continuation signaled by the in-neckline pattern. A bearish crossover occurs when the MACD line crosses below the signal line, indicating that the momentum might be shifting towards a further decline. Support and resistance levels also play a crucial role. These levels are like invisible barriers where the price of an asset tends to halt and reverse. Identifying these levels provides traders with insight into potential entry and exit points, thus offering a fuller picture when combined with the in-neckline pattern and indicators like the RSI and MACD. Integrating these tools with the in-neckline pattern helps traders confirm the trend and make more accurate predictions, enhancing their trading strategies' effectiveness. One common mistake investors often make is interpreting the in-neckline pattern as a signal for a bullish market reversal, especially when they observe a white candle within the formation. It is crucial to recognize that the in-neckline pattern is indicative of bearish continuation, not a reversal to bullish trends. This pattern emerges in a downtrend, and the presence of a white candle might give a false impression of a potential reversal. However, the accurate interpretation of this pattern underlines the continuation of the existing downtrend. Understanding the essence of the in-neckline, observing its formation in the context of ongoing market trends, and not being misled by individual candle colors are key to making informed investment decisions based on this pattern. Recognizing an in-neckline pattern within a downtrend can indicate that the current trend is likely to continue. This pattern serves as a signal for investors to consider maintaining or initiating short positions, which means betting on the continuation of the market's decline. When the pattern is confirmed, it suggests an entry point for these positions. To manage risk effectively, it's important to set exit points or stop-loss orders just above recent highs. This strategic approach helps in minimizing potential losses if the market direction unexpectedly changes. Essentially, the in-neckline pattern offers a framework for making strategic trading decisions by identifying entry and exit points based on established market trends, ensuring investors have a structured method to navigate the complexities of market movements.